The central banks have lost control of interest rates. They cannot suppress the rates anymore because the whole point about suppressing rates is you want to inject more money into the economy. That's the Keynesian idea, to try and rescue the economy. And so I think these times it's rather like an inflection point, if you like, as far as precious metals are concerned. I think there's a gradual awakening in foreign markets about the fragility of the Western financial system. The currency actually has nothing behind it. It is not tied to it. You need to anchor currency to a value, and that has been the role of money, which is gold, silver, copper, whatever. But at times it is gold more than the other two.
A couple of weeks ago, the Fed did as expected and kept the overnight rate unchanged, citing elevated short-term inflation risks. Their cautious stance implies that interest rates will remain higher for longer. The risk here is that prolonged elevated rates could lead to a recession. However, unlike previous downturns, this doesn't necessarily mean lower interest rates. Alasdair Macleod notes that historically, recessions have led to lending crises, requiring higher interest rates, unless the central bank steps in to suppress them and rescue the banks. This pattern has been consistent since the early 1980s. Government debt, which has swelled nearly 50% since the early days of the COVID pandemic, is generating elevated levels of worry both on Wall Street and in Washington. The federal IOU is now at $34.5 trillion, about $11 trillion higher than in March 2020. As a portion of the total US economy, it now exceeds 120%. Alasdair highlights that the government debt has reached astronomical levels after decades of rate suppression, making further suppression impossible. The central banks have lost control over interest rates, and for nations already in debt traps like the US, the only buyer for additional debt will be the Federal Reserve. This will lead to debt monetization, likely accelerating the selling of the dollar in favor of gold. Of particular note, China is offloading a record amount of US Treasury and agency bonds, shifting away from the dollar while increasing its gold reserves by 4.9%. This move indicates China's effort to diversify its portfolio and reduce the dollar's influence. As part of the BRICS alliance, China is working to develop a new currency to challenge the dollar's status as the primary reserve currency. This shift towards precious metals and commodities reflects a reevaluation of traditional investment strategies. Gold and silver gain prominence as safe havens amidst economic uncertainty, underlining the fragility of fiat currencies and financial systems. We will present clips from Alasdair Macleod's interview with As Gold as Australia. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
Basically, things are not all that healthy underneath. We are probably heading into a recession, and that means lower interest rates. No, it doesn't. What it has done in the past is that it has led to a crisis in lending, which requires interest rates to rise unless the central bank comes in and really suppresses rates in order to rescue the banks. And that basically has happened with every recession since the early 1980s. You could just look at the chart of interest rates in the United States, the St. Louis Fred puts in recession bars and all the rest of it. And every time one of those recession bars is there, the rate is falling. This is because the central bank is suppressing the rates. We're now in a situation where, after decades of suppressing rates, the level of government debt has risen to astronomical levels. They can't suppress the rates anymore. And so you made a comment about debt. This is the importance of this debt, if you like, in this situation. The central banks have lost control of interest rates. They cannot suppress the rates anymore. Because the whole point about suppressing rates is you want to inject more money into the economy. That's the Keynesian idea, to try and rescue the economy. All you're doing is you are hampering the evolution of the economy, because the point about a recession is that it drives out businesses which are no longer profitable. It reallocates capital to entrepreneurs, if you like, with new ideas, better products, better services. And that way you get economic progress. But of course, economic progress is not something that you can measure. You can only measure the amount of credit being deployed in the economy. So if you puff up the credit, you create the illusion of economic growth. But actually, all that is going into bust industries, which should go bust, but are basically continuing on the lifeline of suppressed interest rates. That is coming to an end. If you give it another kick, then really what you're telling the markets is that the debt levels are going to go even higher. And these are for countries, for nations whose currencies are already in debt traps. I mean, this is the problem with the US government. I mean, we were talking just a moment ago about the Chinese, selling dollars. And, who's going to buy all this debt? I mean, if you're going to create more debt, the only buyer out there has got to be the Fed. So that's, so monetizing the debt, what does that do to the dollar? Well, I can tell you one thing. It will accelerate the selling of the dollar. But guess what? Another currency? No, it'll be for gold. And so I think these times it's rather like an inflection point, if you like, as far as precious metals are concerned. I think there's a gradual awakening in foreign markets about the fragility of the Western financial system, the fiat currency system. We were talking about, Chinese individuals, but there is definitely in China a greater recognition amongst, let's say, the sort of economically literate or the financially literate about the dangers of a debt trap and the problems that the US government are going to have funding that debt, and the alternative being effectively printing the money, which is what happens when you get QE. So, the foreigners are beginning to understand it. And, of course, the last people to understand it are the people living in the countries affected. I mean, the ordinary American doesn't understand it. I have this problem here, talking to people about this thing. I mean, I've almost given up talking to, they just don't grasp the concept that the currency actually has nothing behind it. It is not tied to it. You need to anchor that currency to a value, and that has been the role of money, which is gold, silver, copper, whatever. I mean, but, times it is gold more than the other two.
The Federal Reserve's recent interest rate hikes, now between 5.25% and 5.50%, pose challenges for Americans pursuing key life goals like buying a car or a home. Despite a slight drop from its peak, inflation remains above the Fed's 2% target, prompting a delay in planned rate cuts announced by Fed Chair Jerome Powell in a May press conference. These rate hikes pose both opportunities and challenges for banks. On the one hand, they can increase earnings by lifting loan rates. However, they also inflate the cost of liabilities and devalue investment securities held by banks. Even unrealized losses in investment portfolios constrain liquidity, challenge funding, and pressure earnings, ultimately impacting capital. Alasdair asserts that financial institutions relying heavily on assets like bonds and equities as collateral are particularly vulnerable as interest rates rise. The drop in asset prices, particularly in bonds, worsens the vulnerabilities already present in the financial sector, increasing the risks to its stability. Furthermore, artificially low interest rates have prolonged what Alasdair calls zombie corporations, businesses surviving solely due to suppressed rates. These entities, resistant to market forces, stifle economic efficiency and innovation, impeding overall progress. Let's get back to the interview.
I mean, if you look at private equity, all that has worked on balance sheet leverage. I mean, in this country, we've got a running sore with Thames Water. Now, Thames Water was privatized back in the 1980s, and the whole idea of privatization, I mean, the reason we had to do it, in effect, was because these neglected nationalized industries needed capital investment in them, and the government wasn't able to do it. So the idea was to shovel it out into the private sector, regulate it to, if you like, give a little bit of cover as far as all the socialist commentators and all the rest of it were concerned. But, privatization, which they hated. So what we ended up with was an absolutely ideal business for private equity, because as interest rates came down, what you could do is you could take an income stream from a utility, which was guaranteed by the regulator, incidentally, because the regulator set the profit margin, and he set the profit margin at 8%. Anything over that had to be invested in the infrastructure and all the rest of it. And in terms of the totality of the balance sheet, water prices would be set by the company and the regulator to ensure that there was money to invest, if you like, in maintaining and improving the water system. But you got a guaranteed slice of 8% profit there. So private equity, what do? Well, you buy the company, don't you? And you buy it with debt, and you leverage it up 5 times. 8% is 40% return on your equity. Wow, isn't this brilliant? Now that works fine until interest rates rise, and that's where we are now. Thames Water can't refinance itself; it's bust. Then, of course, you've got the wider problem, Daryl, and that is that the bank's collateral and the whole system's collateral, like financial assets, not only bonds, but equities and so on and so forth. You get rising interest rates. What happens to the values of those? They go down. You end up with equities with a bear market, and that bear market is going to be very severe. Of that, I have absolutely no doubt. As far as bond prices are concerned, they will continue rising. Remember that Jamie Dimon reckoned 8% was possible, or even more. So what does that do to bond prices along the yield curve? I mean, it collapses them. The whole situation, as far as the financial system is concerned, is turning into one that is virtually impossible to rescue us from without collapsing the currency. So it's not just the real estate, commercial real estate. I mean, in terms of zombie corporations, remember that this sort of zombie problem just increases year after year after year, so long as you get interest rates suppressed. Because the whole idea of suppressing interest rates is so that you don't get unemployment, you don't get businesses going out, you don't get enterprises going out of business, companies, corporations, whatever. That is prevented. And so you've got this huge, great build-up, if you like, of inefficient businesses which have got to go bust. And the whole collateral that is behind the system is also going to go down in value.
As central banks struggle to control interest rates and debt monetization accelerates, gold and silver become increasingly appealing. Recent economic data fuels speculation of interest rate cuts by the Federal Reserve, propelling gold to record highs and silver to an 11-year peak. With government debt soaring and central banks losing control over rates, the stage is set for a surge in demand for precious metals. Share your thoughts on Alasdair's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.